Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's pretty rare to record a drop in unemployment to a 13-year low and for nobody to celebrate. But with hundreds of thousands of jobs expected to go over the next couple of months due to lockdowns in Sydney and Melbourne, the unemployment rate won't stay where it is for long. The economic impact is worsening every day, particularly as COVID case numbers continue to grow, likely prolonging lockdowns and keeping borders shut. I wanted to get another perspective on what we're in for. Richard Yetsenga is the Chief Economist at ANZ and my guest this morning. Richard, welcome to Fear and Greed.
Thanks, Sean.
What do you make of the labour force data last week?
Great labour force data. In fact, for the past year, the labour force numbers have, I think, every month or maybe 11 out of 12 months have surprised the consensus forecast on the strong side. This is the strongest labour market certainly before the financial crisis since 2007, I think.
So were you celebrating last week?
We're not celebrating because, of course, during movement restrictions and lockdowns, I don't really like the word lockdowns. It's just the end of the wedge, really. During these periods of, I guess, more extreme movement restrictions, our time focus narrows right down. And last month was last month, wasn't it? We're more focused on now. And look, unfortunately, it does seem like some people are going to lose their jobs. Maybe the good news is should be a lot less than we saw last year, and that should then provide a reasonably strong base for the economy to transition out of this period of more extreme movement restrictions.
Okay, so what's the prognosis for the next 3, 4, 5 months, do you think, in terms of the labour market?
So I think, look, the next month or two is probably weak. Sydney looks like it's got a bit of a way to go in terms of the movement restrictions that are currently in place. Even if we start to see some easing, let's say next month or so, they're likely to be modest. There's questions now about Melbourne, unfortunately. And while most of the rest of Australia has avoided the worst of Delta's proving itself to be a wily adversary, isn't it? It's difficult to completely get rid of and stay free of it. So, look, we think the odds are you'll see some other movement restrictions around the rest of Australia over the period. So that means things are probably weaker in the near term, but we're already seeing actually that weakness is more controlled than last year. It's less severe than last year. There's less panic. And a big part of that is the policy response is quite good. I think it's tending to keep viable firms afloat during what are temporary restrictions and also keep employees attached to their jobs. And they're two things that really form the foundation of the economy coming back with a reasonable degree of vigour on the other side.
So JobKeeper last year helped people stay in work, or at least stay employed, sorry. We don't have the equivalent this time around. Does that mean that there will be big job losses, even if they're only temporary, in the next sort of 4, 6, 8 weeks, do you think?
Look, they will be meaningful, Sean. But remember last year also there was the fear of the great unknown.
Yep.
Holy smokers, COVID, what is it? Never seen a pandemic. Unless you're a scientist, never really understood what it was like. You know, I have a copy of Peter Doherty's book on pandemics now. It's tough going, I've got to say. Last year, we lost in Australia nearly 500,000 jobs. This year, we think less than half of that. But that's still potentially 200,000 people that will need to find another employer as the economy starts to open up, maybe towards the end of this year and into 2022. Is it nearly 2022 already? Wow, okay.
Yeah. Pretty incredible, isn't it? How do you think, it now seems to hinge on hitting vaccination targets of 70 and 80%, and there's a huge political debate around that. Do you think from an economic sense it will bounce like it did last year, or is the fact that it's not like we're going to suddenly see zero COVID cases now? I think everyone accepts that we're going to be seeing them in the dozens or hundreds as the economy reopens. What sort of impact will that have?
So I think last year the international experience showed actually you can have what looks like an awful COVID situation and the economy actually do okay. India, the US, the UK all had very, very challenging times, enormous human cost, but their economies came back from the most extreme global shutdowns that we saw through March and April last year. So we probably need to think about them a little bit separately. I think one thing that's not clear is how Australia will cope psychologically, economically, from a restrictions perspective with the number of cases. The Doherty Institute yesterday said, and now bear in mind when I give you this number, Sean, Australia's had, I think, about 44,000 COVID cases altogether, I think. The Doherty Institute on their modelling is saying if we follow the path they're proposing, which is obviously the basis of the federal government's program, we should expect about 385,000 symptomatic infections.
Wow, so it's 7 times what we've had.
It's a big number. Whether it's, you and I know, whether it's 385 or 400 or 300,
Yep.
it's a really big number. And I think what the policy response to that is, what the psychological response to that is a really big question. I think also that means that because, at least in New South Wales, we're transitioning to living with COVID, the sort of snapbacks we had over the past 12 months where we had movement restrictions and then went to largely no restrictions, that doesn't seem to me to be the right way to think about it. So I'm discouraging people from using the term snapback. Certainly we'll have recoveries and the fundamentals of the economy are pretty strong, but I think they're likely to be less aggressive bounces than we saw through most of the lockdowns over the last 12 months.
Stay with me, Richard. We'll be back in a minute. My guest this morning is Richard Yetsenga, Chief Economist at ANZ. Okay, so what's your forecast for growth this quarter, next quarter, and then into 2022?
All good questions. So down this quarter, look, we think about 3%. I think we got 3.3 in our numbers. Then we get a recovery next quarter, but not all the way back. So maybe 2.4% of that comes back. And hopefully that is transitioning us into the living with COVID phase. And so hopefully over the next year or two, COVID becomes a less extreme influence on the economy. I think the biggest challenge for growth next year and the year after probably is the international borders. Without the international borders open, potential growth is probably only 1%, maybe, Sean. And the labour market's telling us we've used a lot of spare capacity up. So the economy's ability to grow quickly is going to be hampered if we can't work out a way that people are happy with to get the international borders open.
What's all that mean for inflation and then ultimately interest rates?
Oh, how deep is the ocean, Sean? The unfortunate...
Very, very deep, Richard. Very deep.
Well, let's see. If you're standing on the shore, it's pretty shallow. And I think the problem with inflation is it's the macro variable that determines so much. It's the macro variable that economists have a terrible track record of forecasting. I think we should acknowledge that. Look, I think we've got all the preconditions for inflation we could basically hope for. Very strong monetary response, coming out of a crisis globally with actually some reasonable economic vigour, even if there have been a few disappointments the last quarter or so. We've got the global setter of the price of credit, the US Federal Reserve, with the most permissive inflation stance probably since the 1970s. We've got supply chain bottlenecks. We've got climate change contributing to commodity price strength. There's a lot of things on the list there which says to me, you know, we're going to have inflation. Once we get through this kind of base effects problem with last year's Zoom, we're going to have some higher inflation over the next couple of years. I think we should welcome that. Okay.
Does that mean that interest rates may rise before 2024, which is when the Reserve Bank said it expects to lift the official cash rate?
Possibly, although the chance for that with these latest movement restrictions obviously has fallen. We had expected the bank to be going in the second half of 23. We've now pushed that back to 2024 just because effectively the recovery has been delayed. The full recovery in the Australian economy has been delayed. So I'm less worried about the bank having to go earlier than 2024. I think even if we've had a couple of quarters of inflation firmly in the target band and the bank's in a position to go sometime in 2024, that would still obviously be a welcome return to something approaching normalcy.
Yeah. House prices, I can't let you go without actually asking about house prices. They've certainly done well across the nation, or across the capital cities and in regional Australia over the last 18 months or so. Where do you think they're going, particularly in the big cities, you know, Brisbane, Sydney, Melbourne, Perth?
Demand still seems much stronger than supply at current price levels, to be honest, Sean. Even in Sydney with recent movement restrictions, it seems like desirable properties are flying off the shelves. So further price gains, that will put this year at a 20% plus price gain year, and then we don't expect any sort of crash or anything like that next year. So prices still increase next year, but hopefully by much less. I think more broadly, though, one of Australia's big strategic economic challenges is how do we grow the economy and share prosperity without house prices having to go up much, much faster than income? It just strikes me the equation under which we're currently operating is going to run into some limits at some point.
How do we do that, Richard?
I'm asking you, Sean.
I mean, the wealth effect is such an important part of our being in Australia, and particularly if you live in a capital city, because if you're lucky enough to own a home, it has appreciated. If you've owned it for long enough, it does make you feel better about spending. But if we actually had house price inflation of 3 or 4%, would that actually hurt the economy, do you think?
Our inflation forecast would be different if we had house price inflation of 3 or 4% this year.
Yeah.
So I don't think it hurts the economy, but under the current conjunction, it would make it difficult to get to inflation well above 2%, comfortably above 2%. I think I'm posing the question as a strategic challenge, I think.
Yeah.
And it's a surrogate of the question we should have been asking more intently before, which is consumer credit growth can't keep growing at double the rate of income.
Yeah.
There's going to be a reckoning, and before COVID there was a reckoning, and regulators started to say, debt to income at 200%, that's kind of far enough. That's been removed as a really big source of growth in the economy. The surrogate of that is, house prices are doing something similar. Again, I think whether we can choose the timing is an open question, but we're going to have to find other sources of growth at some point.
Richard, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Richard Yetsenga, Chief Economist at ANZ. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.